Hi, this is Adam Newman, partner and senior wealth advisor at Burney Wealth Management, and I'm joined today by Brenna Surette, one of our associate wealth advisors. This is Byte Size Retirement, where we're going to take common retirement planning topics and break them into 5-minute bite-sized video pieces. This is not investment or tax advice, but hopefully gives you a great foundation to build off of and some considerations for planning purposes. And while we're taking 5 minutes to explain a lot of these topics, definitely do not take 5 minutes to make any of these decisions. Today, we're kicking it off with required minimum distributions, a topic that most anyone has to deal with who is saved for retirement. And I'm going to start with you, Brenna. What is a required minimum distribution?
Yep. So required minimum distributions, commonly known as RMDs, are the distributions that investors must take every year from their pre-tax retirement savings accounts starting at age 72. So these are traditional IRAs, pre-tax 401k accounts, and these accounts are a great way to defer taxes and save for retirement. But at some point, Uncle Sam's going to say, "Hey, I'm ready to collect my taxes on those." So RMDs are how the government ensures that you'll eventually be taxed on those accounts.
And how are they, once the money comes out, how is it actually taxed?
So RMDs are taxed at ordinary income rates. So with the top tax rate of 37% for 2022.
Okay, so just like a paycheck, essentially.
Exactly. Yep. So Adam, could you explain in detail how these RMDs are actually calculated?
Yeah, so the first step in calculating your RMD is you take the December 31st account balance for all of your pre-tax retirement accounts from the prior year. So if we're taking an RMD in 2022, we're going back to our 2021 December 31st account balances for those pre-tax accounts. We're adding it up and we're taking that number and dividing it by a life expectancy factor. So the IRS has several different, they're called uniform life tables that you can reference based on your life circumstances, whether you're single, married, and if you're married, what's the age gap between you and your spouse? And it's a statistical table that gives you this factor number. You can get that through the IRS website or your custodian or investment provider. And you take that account balance, divide it by the factor, and the output of that is your RMD for that given year. So that process is repeated year in, year out through retirement. People always ask, well, what's the number roughly? Like, what can I expect? And a good gauge for the first year at age 72, that number tends to come in around 4% of your pre-tax retirement account balance total. So so that's the calculation. And Brenna, what about like the question that I get all the time is, do I need to take it?
Yes, so you can't leave it in the IRA. You definitely do need to take the funds out, otherwise you'll be hit with a hefty 50% penalty. So even if you don't necessarily need the funds for living expenses, one route or recommendation we suggest to clients is take those funds, put them in just a taxable brokerage account. That way the funds are still invested, still growing for you, but you are still satisfying that required minimum distribution. And a quick note, inherited IRAs do have some different rules to consider on top of all of this. So just wanted to add that note as well. But on this topic, Adam, what are some ways that people can reduce their RMDs?
Yeah, question we get all the time, hey, I don't need it. Do I have to take this? So obviously we know there's a penalty, but the next layer is like, can I plan around this in any way? And the first and easiest way to do it is by moving as much money as you possibly can into Roth accounts. So while you're saving, if you're still saving and accumulating, knowing that, funds that ultimately will be in a Roth IRA are not subject to the RMD rules is one thing and a big benefit. And then the other is if you're able to convert funds from a regular IRA to a Roth IRA at some point, that's another really big planning opportunity. And we've got a video specifically focusing on Roth conversions, which is a great reference to look at if that's something you're considering. And so once you're beyond all that and you can or cannot get any more money, into Roth, another opportunity you have is what they call qualified charitable distributions or QCDs. So these are direct payments that you make from a pre-tax IRA directly to a charity, a qualified charity of your choice. So the limit on that is $100,000 per year. But essentially what happens is when you do these QCDs, is it reduces the amount of your RMD liability for the year and it's not taxable in any way, shape, or form. So if your RMD is $200,000 and you make a $100,000 QCD, all that's left for you to take out and what would be subject to tax is the remaining $100,000. So huge planning opportunity for those that are charitably inclined, along with the Roth conversions as well.
Definitely. Great. Thanks, Adam. Well, it looks like we made it in under 5 minutes. So thank you so much for watching. Be sure to check out our other Byte Size Retirement videos and reach out if you have any questions at all. Thanks.